Inflation is out of control. Food and fuel prices typify the magnitude of the problem. The Consumer Price Index came out recently through the month of June, showing that the CPI, Consumer Price Index, is 9.1%. John Williams, economist at shadowstats.com, has tracked the real rate of inflation going back to 1980 and adding back in the items that have been intentionally taken out to suppress the real rate of inflation. He says the real rate of inflation, when everything is added back in, is 17.3%, not 9.1%. My name is Ben Ripond. Welcome to my broadcast. Today is July 19th, 2022. I will cover the real rate of inflation. Chinese banks are freezing bank accounts, customer assets. The 7-year cycle of stock market crashes, I will cover that back to 1900 and how that cycle is still in effect today. And then I will cover my stock market dashboard and indicators. Each month, John Williams, economist at shadowstats.com, illustrates at the bottom of his homepage the real rate of inflation. And again, he's tracked this all the way back to 1980, and he has seen a divergence in maintaining the methodology that was established in 1980, comparing everything. And he compares that to the red line, which is what the government reports. The spread between those two has become greater and greater. Why? David McAvaney reports that the Bureau of Labor Statistics has manipulated the Consumer Price Index downward nearly 24 times. Nearly 24 times, always moving it down. Why? They admit that what they're trying to do is to have the increase in Social Security payments be affordable for the government. Another way of saying that is they are harming those senior citizens who are drawing off of Social Security, and others who are drawing off of Social Security and not getting the rate of increase that matches the real rate of inflation. So no surprise. Here we have the government reporting something that people are actually counting on, and it's inaccurate. And it's been inaccurate for a long time. To make this worse, when you look at that 17.3% or the 9.1%, let's just start with the 9.1%, it's actually worse than that, even using their methodology. And I'll explain. The way they calculate this is it's the change from 1 year ago to today. So it's year over year increase, let's say 9.1%. However, each month that makes up that year is a different number. And by using a year, it does smooth out the rate of change, because each month you would add one more month and take one more month off and so forth. So the change would be more gradual. However, when you take the most recent month, in this case the month of June, the increase was 1.3%, a shocking number. 1.3% times 12 is 15.6%. 15% using their numbers, using the red line. Now that rate of change is, I'm measuring just 1 month, and I'm assuming an annual rate by multiplying it times 12. And that's one way of looking at it. It may not be completely fair, because that's It would bounce around a whole lot if we did that. But it tells you that for the current month of June, which is the month we're shopping in and buying gasoline and so forth in, compared to the previous month, an annual rate of 15.6%. Now take the differential between the red line, the number that they manipulate, and go to the blue line, the real rate of inflation, and that is going to put you nearly to 24%, at the rate of 24%. That's what we're experiencing right now compared to last month, month over month, when everything is added back in. So that, whether it's the 17 or the 24, those feel about right. They don't feel wonderful, but it feels like about what we're experiencing, not 8% or 9%. And the government wants to bring this down to 2 or 3%. That's just smoke. It's not real. We're not going to have that kind of inflation. Even if they pull it down, it's not going to be that number. Whether you take the 17% or the 24%, these are numbers that the financial advisor community cannot accept. You will never see this chart from a financial advisor because they cannot live with that. Their whole model, everything that they're projecting on the investment of their portfolio to their long-term projection on inflation, everything collapses if they can't use 2 to 3%. So you'll never see it. But I just thought I'd show it to you. This chart shows again, this is year-over-year numbers, and it just takes three components of the Consumer Price Index. One is gasoline. Gasoline up 60% year over year. I think there are clearly areas where it's up 100%. That's anecdotal, but this data shows nationally up 60%. Utilities up 39% year over year, and electricity up 13%. As inflation goes up, this puts more and more pressure on the Fed to raise interest rates. And they've already announced they're raising rates this month, and they have other planned increases for this year and even into next year. As they raise rates, this is putting pressure. There's a correlation between raising rates at the Fed, the overnight bank rate, to mortgage rates. They are not directly tied, but clearly the raising of rates on the Fed side influences the pushing of rates up on the mortgage side. About a year ago, I remember the average mortgage rate being around 3%. I think there were cases a little less or a little more, but 3% was not uncommon. Today, it's 6.5%, more than double what it was 1 year ago. So what we've got going on is very high housing prices, and people have been able to afford those in a number of cases because they've had low interest mortgages. So it kind of worked. Well, now with mortgage rates zooming up past 6%, and I can see it going much higher because the Fed has announced they're going to raise their rates much higher. As they do, I can see mortgage rates following. You know, will they get to 10% or beyond 10%? I mean, I think that's entirely possible. So while there is supply and demand going on in housing, people are concerned about is housing prices are going to collapse? Are they going to come down? They are clearly already softening in many markets, and the heated area of increases and buyer demand has slowed down already compared to earlier in the year. But I can see this changing quite a bit and probably having a big impact on the prices in housing. This shows the impact of rising interest rates on mortgages. This is a chart showing, a weekly chart showing the amount of mortgages that are being refinanced. And a big part of the mortgage market has been refinancing. Certainly new buyers, but nearly everyone who's had higher interest mortgages has been enticed into and willingly jumped at the chance to refinance at lower rates. Look at what's happened to refinancing. It's just dropped right to the floor. So again, big impact on the mortgage industry and the housing industry. Do you realize that stock market crashes, and I'm going to go back to 1900, so this is about 120 years, but that stock market crashes actually have highly followed a 7-year cycle? Did you know that? Have you heard that before? I'm going to take it back to 1900, but actually I think it goes back even further. I think it goes back thousands of years. And I'm going to give you the background and sort of unpack this for you to show you this 7-year cycle. Now, to do that, I need to go back to ancient Israel. And so this is going to, if you're not a religious person, this may not be of that much interest, but I'm going to hang in there. I'm going to tie it to the current conditions, the current market, the last 100 years, the last 20 years, and today in 2022. This is still playing out. I find it interesting. If you're interested in history, I think you might find it quite interesting. So I'll give you the background. This goes all the way back from Jewish perspective, the Torah, the law, all the way back to the beginning. In Christian circles, this is, the Old Testament. These are the books of Moses. And the way God organized this was for people to work 6 days and then take a day of rest, the 7th day. He went on to establish a 7-year cycle where people would work for 6 years and take the 7th year off. They would also let the land rest that 7th year. Further, they were instructed to not just do that, but to forgive debts of people who owed them money. And so here's how that worked. If a person, let's say a person was poor, or they fell into poverty or hard times, or made bad choices, same as today, if that happened, there were no banks. There was no place to turn to get out of trouble. So people were faced with, in these circumstances, you're basically going to starve because you don't have a means to survive. So God established it so that those who had money, who land and cattle and resources, they would bail these people out. They would cover the loan for them. But in exchange, the borrower would actually become enslaved. They would be an indentured slave to the person who bailed them out. Maybe they were a friend, probably were. And they would work for that person until they worked off the debt. If they could not work off the debt, this is the way it was written. If they could not work it off, on the 7th year, the debt was forgiven. And they walked away. Generous landowners and lenders would actually, in some cases, give those people some land, a portion of land, so they could become self-sufficient and not fall back into poverty. On this 7th year, it was called the Shemitah year. And Shemitah in Hebrew means release. So the land was released, the debts were released, and the people were released from their work. So I think of it like this. I kind of bring it to today. Of course, I don't think that would work in today's culture, but But I think of it today, of how this would work, of how dramatic, how collapsing this was to their economy and their financial system, which was an agriculture-based society. Think of this. If you did not work this year, just didn't work for whatever reason, you just took the year off, how would that go? How would you pay your bills? How would you eat? Well, that's what it was like. Now imagine that on a national scale. What if every business, in this case it was agriculture, but what if every business closed for a year? And what if everybody's job, okay, take the year off, take a sabbatical, just relax, enjoy your life. How would that go? Well, the way I think of it, the stock market would go to zero. The bond market would go to zero. The real estate market would probably go close to zero. The job market, non-existent, go to zero. That's what would happen. They were faced with the prospect that every 7 years, this is how it would go. So this was a collapse. Jonathan Cahn, in his book, The Mystery of the Shemitah, chronicles this, and he says, this is called a financial reset, a financial and economic collapse. And when you bring it forward, I looked up the last 14 collapses of the stock market going back to 1900. Now, I could have gone back to 1800. I mean, there are records that would clearly take us back to 1800, or maybe even into the 1700s a little bit. But the markets get a little fuzzy, and maybe it's not quite as relevant. But I think these 7-year cycles, I can't remember with Jonathan Cahn if he went back into the 1800s. He might have done that. But I took it from 1900 to today. So that's 120 years, and I want to show you the cycles. I'll be brief on this, but I wanted to chronicle the crashes in the stock market and the economy and how this corresponds to the Shemitah year, the 7th year in the 7-year cycle. Now, to do this, the Jewish calendar is organized, it's a lunar calendar, so it's organized around the phases of the moon. And for most of us, the calendar that we work from is the solar calendar, and they're different. So the beginning of the lunar year, the Jewish calendar, begins in the fall, typically in September, and then it goes until the new moon about a year later, usually September. So when I tell you a year, I won't tell you a year, I'll tell you 2 years. It's the 2 years that straddle that where that lunar period was, that 7th year in the lunar calendar. So bear with me. Okay, so 14 of them. Beginning 1901, 02. Stock market drops almost 50%. 1916 to 17. Stock market drops 40%, and the United States enters World War I. The economies of Germany, Russia, Austria, Turkey, and Great Britain collapse. 1930-31, the Great Depression, the worst financial crisis in modern history. The Dow Jones Industrial Average collapsed 88% from its top down to its bottom. And the heart of that was 1930-31. 1937-38, the second Great Depression. The stock market had risen from its bottom in 1932, went up a ways, and then collapsed in 37-38, and that was actually called the Second Great Depression. 1944 to 45, this was the end of World War II. The German Reich is defeated. And of course, we remember Japan, Hiroshima, Nagasaki. Japan was in ruins. And it was the end of Britain's hold on its territories. Definitely a year of collapse. 1965 to 66, the stock market drops almost 25%. 72-73, the stock market crashes again almost 50%. This is also marked by the U.S. oil crisis and a global recession. 79 to 80, global recession, stock market collapsed, prime interest rate went all the way to 21%. 86, 87, Black Monday, the Dow Jones Industrials dropped 22% in a single day. 93, 94, the bond market crashes. 2000 to 2001. Now this gets interesting here. 9/11 occurred. The New York Stock Exchange closed shortly after the Twin Towers were hit on 9/11. When it reopened on September the 17th, and it collapsed that day. That was the very last day of that Shemitah year. That 2000-2001, the last day was the day the market opened after the 9/11 crash, and the market collapsed. 2007, 2008, again, very interesting. On the last day of the Shemitah, the last day, September 29th that year, the stock market had its largest drop in history. Do you think these are coincidental? Really? Or do you think there's a pattern here that maybe there is something to this Shemitah year? 2014-15, Greece bailout and European debt crisis. And then this year, the Shemitah year began in September of 2021, and the last day of this year is September 25th, 2022. Already, so far, stocks and bonds have collapsed together, catching everyone by surprise, except maybe those who follow the Shemitah. When have you ever heard, and this is really what caught financial advisors off guard, when have you ever heard of stocks and bonds collapsing together? It's supposedly unheard of. Maybe it's happened, but it's been probably a long time. And we have 10 weeks to go. 10 weeks left in the Shemitah year before September 25th. Now, I want to give you a caution here. I'm not saying, because you can see the pattern that has happened many times. There are Shemitah years where there is not a collapse. However, when there is a collapse, it seems to happen in a Shemitah year. Already, you could take the first 6 months of this year, and with these stocks and bonds collapsing, and it would fit into this narrative. It doesn't have to collapse any further. It may. We'll know that in retrospect. I think it will collapse. I just don't know when that's going to happen. Is it going to happen in the next 10 weeks? If it does, it won't surprise me, but I want to give you a caution to not think or say, Ben said the stock market is going to collapse in the next 10 weeks because it's a Shemitah year. I did not say that. So be careful. I will say what is in trouble is, I think, the same thing that has been in trouble this year, and that is traditional investment portfolios and 401k plans that follow a traditional asset allocation, stock and bond portfolio methodology. They have failed investors this year. You know this already. And I believe that whenever there is a collapse, if it is in the next 10 weeks or beyond, that whenever that happens, those traditional portfolios will fail investors again. That would be a word of caution. You just have to think about it. We don't use that methodology for investing. We use active management, and it's tactical, and we get in the market and we get out of the market. In the market when we believe mathematically that it is safe and a safer period, and we get out of the market when risk starts to rise. Again, not perfect, but it has worked very well, and that's a method we will be using going forward for sure. I want to show this to you. The banking system everywhere is fragile. It's fragile in the United States. And I won't get into what it is. It's a fractional banking system. Maybe one time I'll cover what that is and how it works, but it's fragile. But it's not as fragile as it is in China. In China, they're already locking people out of their bank accounts, and people are standing in line for days waiting to get their money. Many of them believe they won't get their money. And it's a sad situation, but because this is going on in China, there is a concern that there will be a run on the banks, that this will spread into fear, and banks will do what they have to do to defend themselves, and this won't go well for their people. But when things like this happen, this can have a way of spreading. So we're not at this point in the United States yet, but it's sobering for sure. I'll play this for you.
It's becoming less safe to deposit cash in China's banks. The entire banking system, including the big four state-owned banks, are now restricting withdrawals or online transactions. China is likely to have a massive bank run which will collapse the banking and monetary system, thus further devastating the Chinese economy. This is Dandong, a city in Liaoning Province, a major heavy industry province in northeast China, where people have been waiting in long lines at banks almost every day recently, hoping to get their money. Because the line is so long, local police have come to the scene to maintain order. I went to the agricultural bank, which had no money, and I went to the Dandong bank, which was so crowded that I left, wondering if those people in line could finally take out their money. This is Dandong Bank. It was like this yesterday. Every day is like this now. Some come early before the bank opens. The queue has stretched into the afternoon. Look how many people are already here. Some have been in line for a week. The bank is running out of money. Here is one of the richest cities in China, Shenzhen, where people are also standing in long lines at the entrance of the bank, waiting to withdraw money. People, come and see. This is the Bank of China at 6 or 7 a.m. People came to line up. They haven't even had breakfast. They came to the bank. It's 10 o'clock now. We are still in line. The bank says they don't have any more numbers and they won't serve us. Chinese official media has indirectly confirmed that to a certain degree a bank run is happening in China. The headquarters of the People's Bank of China in Shanghai said on June 20th that in the first half of June alone, cash deployment was nearly 4 times that of the same period in 2021. However, the bank didn't elaborate on whether the total amount of cash was sufficient to meet people's withdrawal needs. The rush to withdraw money shows a serious loss of confidence in banks. Banks in China aren't financially transparent, and neither is the government oversight. But through the recent series of events, we can still see this trend of declining trust from customers.
I want to show you a couple of charts. These are courtesy of my friend Don Creech. One is the inverted yield curve for this year, 2022. Now, what the inverted yield curve is the ratio of the 2-year to the 10-year bond yield. And when the 2-year, when this goes negative, it means that the 2-year yield is higher than the 10-year yield, and that's inverted. That is normally not the way it should be. The 10-year should be higher because you're for a longer investing period. You're taking a greater degree of risk, and you should have a greater degree of reward. And but when those get inverted, they get reversed, and people are for the 2-year are getting a greater amount than the 10-year. It tells you that it has historically been an indicator that there is increased risk in the market, and has been usually foreshadowed for the last 50 years, has foreshadowed the coming of a recession. So here you see where this yield curve is now, the 2-year yield getting much greater yield than the 10-year, and this has caused the relationship of those two, 10-year being the numerator, 2-year being the denominator, to go negative. This puts it on a longer cycle, a 20-year cycle, so you can see what happened previously and where it is today. Again, foreshadowing a recession. Another indicator of a recession is that copper, which is an indicator of a recession, has collapsed. And it's down 30% from its high in March. And you can see where that is now. Now I want to get into the dashboard indicators. This shows, and I focus on the last column year to date, this shows the change, the percentage change from the beginning of the year through this past Friday. And I'll just go through these. I list a number of assets, and they're just things that I think are interesting, that are indicators. The major averages for sure, but also I throw some others in just for fun. The Dow Industrials down 14% year to date. S&P 500 down 19. 20-year Treasury bond down 21%. The long-term Treasury bond, and that is the culprit. That's why, or bonds in general, is why portfolios have collapsed. NASDAQ 100 down 26%. The technology component of the NASDAQ 100 down 32%. ARK-K Innovation Fund down 53%. And I like to pick on Netflix, down 68%, and Coinbase down 78%. Not a pretty picture. And this dashboard shows that at the end of the week, on Friday, I look at moving averages, and they're an indicator. So if an index or a stock is above its moving average, that is generally considered a positive sign, and maybe a bullish sign, certainly positive. And I indicate that on the right side with a green dot. If it is below its moving average, which is generally negative, it's a red dot. So there are several indexes here, and on the right side I'm measuring the 20-day, the 50-day, the 100, and the 200-day moving averages. And if those are moving in a downward direction and the index is still below that average, that's generally considered negative. So the Dow Industrials only above its 20-day. IWM, the Russell Small Cap 2000 Index for small companies, above its 20-day. S&P 500, SPY, above its 20-day. Gold, below GLD, below all of its averages. Emerging markets, EEM, below all of its averages. NASDAQ 100, above its 20-day, but below the other averages. EFA, which is the developed markets, Europe and Japan mostly, below all of its moving averages. And then Netflix above 20 in the 50-day, and Coinbase still below all 4 of its moving averages. So compared to last week there were 7 green dots. This week there are 6. And there are 9. I don't know if I would count Netflix and Coinbase. So without those, there would be 7. And there are 6, counting all of them, there are 6 this week, and there were 7 last week. So not necessarily yet moving in an upward direction, still in bearish territory. There are 11 sectors in the S&P 500, and these are the 11 sectors, and they're indicated in the second column, and then the ticker symbol is in the far left column. And then for the week, the month, the quarter, and year to date. And then I show, separate from those percentages, I show, are those sectors above or below their 20, 50, 100, and 200-day moving averages. Again, kind of indicating a bullish component or a bearish component. To what extent are these really participating and moving up? And there were 9 this week, and there were 10 the previous week. It's really pretty full of red dots. So this is still considered definitely bear territory. This is a weekly chart showing 1 move equals 1 week over the past year of the S&P 500, represented by the Exchange Traded Fund SPY. And I draw the black arrow to show you the general direction of the market, the broad market, which I'll call the S&P 500. So it is still in a downward trajectory, still moving down. It has not broken the trend line. It has not broken the moving average. So that's where we are. The S&P 500 is broken into 2 types of stocks. They're all large companies, growth stocks and value stocks. And so this puts growth stocks as the numerator. It's a ratio. We're plotting a ratio. So the growth stocks are the numerator, the value stocks are the denominator. So if it is going up, this means that growth stocks, growth type stocks, are more in favor. If it is going down, this means value stocks are more in favor. They may both be going down, which they are, but value stocks would be going down less than growth stocks. And that is still the case based on this measurement. This is over a 24-month period of time. So I'm switching from 12 to 24, looking at the small cap index, the Russell 2000 index, IWM is the ticker, and looking from its top all the way down to where it is now, or as of Friday. This is a ratio. We're plotting a ratio. IWM, the Russell 2000 small cap index, is the numerator, and SPY, the S&P 500, the broad market, is the denominator. So if it is going up, this means that small cap is in favor. If it is going down, this means that the S&P is in favor. In this case, both are going down, but the S&P 500 is going down less than the small cap index, as you can see from this ratio. This is a 12-month chart for TLT, the 20-year government bond ETF, and it ticked up a little bit last week, and that was good for bonds, but it is still in a downward trajectory. It is still in bear market territory for bonds, has not gone above its 20-day moving average, and has not established an upward trend. So stocks and bonds are still in bear territory and out of favor. The gold, and I changed this to a 12-month chart. I was showing 24, and it's easier to show the direction and the pattern. Gold is in a downward direction right now, definitely in bear territory. It at some point is going to hit bottom, and at some point is going to probably, like gold does, probably rocket up, but that has not happened yet. It's still going down and is for the time being, short term, in bearish territory. Silver, even more so. Silver is down from its high, and this I'm showing an 18-month chart here, again, to illustrate my point, going from the high and down to where it is today. Clearly bearish conditions and well below its moving average, at least for the short term, intermediate term. The ratio of silver to gold, silver means that it is the numerator, gold denominator. So if it's going up, this means that silver is in favor, relative to each other. If it is going down, this means that gold is in favor relative to silver. Gold would have gone down less than silver in this example. So you can see the relationship and the degree to which gold is favored over silver. Both, though, are going down. I show the volatility index and put a marker at 24 because it is generally agreed upon that is the unofficial mark of bear territory or bullish conditions, more less risky environment for investing would mean this would be below the black mark. If it were a more risky environment, it would be above that mark. And it's very close. It's almost touching 24. So it's kind of, is it going to go back up from here, or is it going to break through that and go on down? We don't know. So, but it's flirting with, should I become more risk averse, or should I become more willing to take risk? Where that black line is. We'll see next week what happens. Asbury Research puts out indicators. This is what they call their Asbury 6. Their metrics, 6 different metrics for measuring the market, and they have 2 of those that are positive and 4 of those that are negative. And this pretty much matches with a lot of the data that I've shown you earlier on my dashboards to show that most of them are negative and some are turning positive. The cross-asset relative performance that they established, this is very interesting because some of these have changed just this last week. And I'll try to point those out. But when you look at the relativity on a performance basis, measured in the kind of the center column, weekly, monthly, and quarterly, 3 different views. If they are, whichever one is in favor, it will indicate. If it's strongly in favor, it will be in green. So when measured, and you could remember I showed you this on the chart earlier, the large companies versus small, S&P versus SPY versus IWM, clearly the S&P was way in favor, and that is showing the same here, large cap over small cap. S&P 500 versus NASDAQ, and this is what has changed from last week. So the NASDAQ 100 on the short term, the last week, the last month, the last quarter, is actually more in favor than the S&P 500. So it's shifting. S&P 500 was in favor, now shifting. And then growth stocks versus value. In the short run, growth is starting to outperform value. And for quite a while, during the most of this past 6 months, value has been in favor. That's shifting over to growth now. And U.S. versus developed markets and emerging markets, again, that has shifted because both of them were in favor for quite a while over the U.S. And back on the growth and value, when we get back into the market, we will be determining whether we're in a growth index environment or a value index environment, and we'll be investing accordingly. We want to go with the one which is most in favor, and that is showing right now to be growth, even though value has been in favor for quite a while. And then in bonds, this is interesting because this is because of the move up last week. In particular, it's influenced the weekly, the monthly, and quarterly view that long-term bonds are doing better than short-term. And again, that's a change from most of the last 6 months. We don't have anything. On U.S. versus any other country or region, the U.S. is not in favor. Now, it's indicating that the U.S. is in favor, but slightly, not enough to even get a green box. So the only one that's getting a green box is India, and that's for the monthly and quarterly view. But all the others they're not giving favor to the U.S. or to these other countries. Gold and silver, I've shown you that they are down. Gold is down, is at 1707 on Friday, and silver 1871. Now, I've made this point, I'll always make it, and that is I buy silver, I prefer silver. I do not buy silver for an investment. I personally don't care if it goes up or down. That's not why I buy it. I buy it as a store of value, and if we were to ever get to the point where we needed to rely on bartering, and we had the kind of collapse that required us to barter for food and fuel and things that we need, that's why I would use it. And I think it would be very helpful in that environment, and I do hope we don't enter a period like that. Okay, this kind of tells you what's coming. We've already covered it. The report for June showing 1.3% annualized over 15%. The true number over 23%. Yeah, inflation's a problem. And the Fed is still tiptoeing in a tepid kind of way, tiptoeing into the water, raising rates in a very gradual way, really not dealing with inflation. I don't see inflation coming down with that kind of approach for quite a while. Eventually, with enough increases, yeah, you'll crush it. But what the consequence of raising rates high enough, and they know this is why they're trying to have it both ways, is that the consequence of raising rates is they're going to crush the economy. You'll crush the stock market, the bond market, probably the real estate market, and the jobs market. You'll crush all of those if you raise rates too much. So they're trying to gradually raise rates, but meanwhile, inflation rages on. Thank you for watching. I want to say again, thank you so much for those that watch and share and comment. I really appreciate the favorable comments that you've given. And if you like it, give it a thumbs up. That's just been, I tend to get around 98% thumbs up and some wonderful comments. So that's extremely encouraging. Thank you very much. If you do have comments, please leave them in the comment section below. And if you want to share it, certainly do that. Thank you very much for watching.